Hello and welcome after the break. You're watching Markets at Noon with me, Ankur Mishra and Mansi Dave. Mansi, the market is steady, if I can call so, with after day's low, which has touched around 25,188 mark, and now so I'm sorry, it was around 24,881 mark, and now we are comfortably above 25,000. But to understand,
the bigger question is, when do we see the next bullish phase, a constant bullish phase of the market, right?
yes, the VIX is up today. But to make a sense of markets and what does it mean, will 25,000 mark on Nifty sustain? We have with us Nikhil Ranka, CIO Equity Alternatives, Nuvama Asset Management. Nikhil, welcome to ET Now. I saw your medium term outlook of Nifty 26,200, which means around 1100 to 1200 points rally from here. How do you gauge the market currently, and by when do you think that mark will be achieved?
So, good afternoon, Ankur and Mansi. So, Ankur, if you look at the maths, when we have put out a fair value of close to 26,200 in Nifty, you go back for the last 7-8 years, and if you look at the broad trading range, the multiples at which indices have traded, you will find that markets have traded between 19 to 20 times 1 year forward earnings. Now we ended FY25 at closer to 1,020 rupees of EPS. And if you build in the consensus estimates for the next 2 years, we are somewhere closer to 1150 for FY26 and 1300 rupees for FY27. And therefore, if you put that same 20 times earnings to that EPS of 1300 rupees, you are potentially looking at 26,000 on the Nifty. Now, the only thing we have to look out for is these estimates build in a 12 to 14% earnings CAGR for markets over the next 2 years. And we have started to a very slow start. So this quarter and next quarter, we will have a single-digit earnings growth for Nifty names, predominantly because banking sector is facing a lot of NIM compression. And even for IT, given the uncertainty around tariffs, decision making has got delayed. So we are banking on a recovery in the second half of this year for us to get to that 1150 rupees of EPS for FY26, and then the sort of earnings recovery continuing into FY27 for us to get to that 26,000 levels over the next 9 to 12 months.
Agreed to that. Good afternoon, Nikhil. And like I was saying, yes, markets are performing, but then there are ups and downs and there are a lot of volatility, which is of course the nature of the market, but we are still waiting for an absolute constant bullish phase. Having said so, what are the next triggers? Is it the earnings that will help the market, and in particular, what are the top compounding themes? Yes, you did touch base the banks and financials, but will it be the consumption theme that will help the market? Is it the automobile which will again come back? What according to you are the themes at present, and what is the investment philosophy which you're maintaining at present?
So Mansi, if you look at it, two sectors where we are relatively bullishly positioned is cement and telecom. So if you look at both the structure, both the sectors, both are heading in an oligopoly structure. So if you look at telecom, for example, Reliance and Bharti will together account for close to 80% of the market share. And there the point is there's very little global uncertainty that can impact the earnings for these sectors. We had a tariff hike 9 months back, more or less that tariff hike has got absorbed. And we are looking forward in the next 3 to 6 months that one more tariff hike should come through. And the incremental flow through of EBITDA for telecom companies is almost 70% because the costs are more or less fixed in nature. Telecom infrastructure cost is the major cost, which doesn't change so much. And therefore, we believe that's one of the sectors where earnings visibility is high and therefore multiples should sustain. Secondly, if you look at cement, again, if you look at the replacement cost, which is close to $120, you add some working capital requirements. You need the sector to make close to 1,500 rupees of EBITDA to get to that 13 to 15% ROCs. Today, the sector is more closer to 1,000 to 1,100 rupees. And if you look at it, it's got consolidated between Ultratech and Adani's. Close to 350 million tons is now between these two players. And my sense is the same thing that we saw in telecom 9 to 12 months back, that slowly pricing started increasing. The same thing is likely to pan out for the cement sector also. So we feel that there will be earnings as well as multiples re-rating for that sector. Coming to the earnings outlook, I think the market is waiting with bated breath as to what happens on 1st of August, because we'll get a clarity on what will be the tariff outlook going forward. Because what has happened is, given that companies had this 3 month window from April to August, a lot of shipments would have taken place in this 3 months. And if we have a high tariff structure coming through, then Q2, Q3 could have some challenges for exporters in that sense. We are anyways looking at single-digit earnings growth for Q1 and Q2. If something goes awry on that front, then even Q3, Q4 becomes protracted in terms of recovery. So my sense is, if we have clarity in August on tariffs and they are not very bad, market should take heart from that, and from there on, because uncertainty is something that markets clearly do not like. So once we have the certainty on tariffs coming through, that is when I think market should start their next leg of upward journey.
All right, you mentioned about earnings season, and Infosys is one of your top holdings with results due in a couple of days. But other IT majors have posted the results which Street has not liked much. But overall, if you talk about IT sector, Nifty IT has not fallen as much as bad earnings they have posted. What is your view on IT?
So Ankur, we did this study for IT companies even during COVID period, where there was a lot of uncertainty, and what we saw that was during that period of initial uncertainty where there was no visibility as to how earnings would come through. In that year, for rest of the sectors, we had seen 50-60% earnings downgrade. But eventually, IT was one sector where revenues were more or less flat, and there was very little earnings downgrade. My sense is the same is happening with IT even this time around, given the uncertainty around tariffs. Q1 and Q2 are likely to be weak because a lot of decision making has got deferred. But my sense is Q3 onwards, these stocks will start performing because we will have visibility on revenue growth coming back. And the good part about IT is none of these companies are levered in terms of their balance sheet. So it's always a P&L issue, which is a very short-term issue and very easy to repair. The problem comes with stocks where there is a big hole that happens in the balance sheet, things get levered, and then it takes 3-4 years for the entire repair of balance sheet to happen. That is not our base case in IT. We feel Q3 onwards things should start coming back, even if you look at the consensus estimates for Infosys. For rest of the players, we have seen a constant currency decline that has happened in Q1. Q2 outlook is also subdued. But for Infosys, the broker estimates are suggesting that they should have a closer to 2% constant currency growth this quarter. And if that happens, in most probability, my view is there will be an guidance upgrade that will happen for Infosys, because they had guided for 0 to 3% constant currency growth when they had come out with their outlook. My sense is that could get upgraded if we see a 2% constant currency growth in this quarter for Infosys.
Nikhil, as shared with us and given by you, the famous market quote, it's not whether you are right or wrong in markets that's important, but how much money you make when you're right and how much you lose when you're wrong. I completely second the thought. While we're thinking this, what's your advice to the market participants, the viewers who are listening to you at present through our medium? What should be the strategy, be it the broader markets, be it the benchmarks, the mid-cap, small-cap, while they are drawing their portfolio?
So Mansi, if you look at the longer term returns of market, the markets have, in that sense, given returns which are more or less in line with the nominal GDP growth. One of the only things that you have to watch out for is to avoid the flavor of the season stories and not get into stocks where the euphoria is built more on hype and actual numbers are just not visible. So we will look for a philosophy at growth at a reasonable price, stocks and sectors where even if on a near term basis they look a bit expensive, but the longevity of earnings is there. The worst case that can happen then is probably for 1 year you don't make returns, and as earnings catch up, next year onwards you still get back to your compounding of that 12 to 15% growth. We do not want stories where there is a risk of permanent loss of capital, and so investors should look out for core fundamentals, cash flows, earnings visibility when they are constructing their portfolio. In terms of guidance, I would say from large caps, 10 to 12% earnings growth is something that you should keep expecting, because our nominal GDP growth is also around that 10-11%. And if you do some sort of decent stock selection, sector picking, then broadly 12 to 15% is something that investors should expect the compounding to happen from markets over the medium term in that sense.
All right, Mr. Ranka. One thing more I want to know from you is regarding oil and gas sector. Now, Reliance has posted earnings on Friday. What is your view on that sector?
So if you look at Reliance, broadly you can dissect it into three broad segments. One is the oil and gas, other is retail, and the third is telecom. So if you look at telecom, that is where the key sort of stock price driver is there, because they have now close to 45-47% market share on the telecom, and the street is looking out for some signs of tariff hikes that should come through, and whether we get some clarity on when Jio listing could be there when we have the AGM somewhere in August. That is one of the trigger that is the street is looking out for. In terms of oil and gas, if you look at it, there's not much expansion that's happening there. So that's a steady state 60,000 crores EBITDA run rate that the segment is delivering for them. In terms of retail also, if you look across the sector, be it trend, be it demand, everybody, the growth has slowed down a bit. You have seen contraction in growth rates across the sector. And that was something that was visible for Reliance as well, that, retail didn't grow as much as expected. And that is where the disappointment of the street is. And secondly, you have to understand that the base has become quite big for Reliance. So, we are at close to 170,000 crores of EBITDA base for Reliance, and the management has guided that by end of the decade, they will look to double the EBITDA. If you hold patiently for 5-6 years, in line with what the EBITDA growth will be, one could probably look at 12 to 15% returns in the stock from here on.
Okay, thanks Nikhil. Thank you so much for your time and view on the markets. It was quite an insightful conversation. Thank you and have a nice day to you.
Thanks.
Well, moving ahead in a fresh monetization move from Eternal, it's